All right. Good evening, everybody. My name is Amy Scott-Sanjur.
I'm Catherine Schmidt.
And I'm Kenny Chavez.
And for our financial statement analysis and business valuation class, for the final project, we decided to focus on Phillips 66 and Shell. So that's kind of what our analysis and presentation will be about. As far as an agenda goes, we are going to be going over both of the company's histories, as well as diving into their business segments and kind of how they make money and are operated. And then we'll dive into the financial statement analysis portion where we'll go into detail about the ratios, and then finally end with our recommendation to either buy, sell, or hold the following companies.
Okay, so let's start with an overall analysis of the oil and gas industry, which is the industry that Shell and Phillips 66 are both in. The oil and gas industry is a global industry that is constantly changing. It's very dynamic. Prices are always changing. There's a lot of political factors involved. So companies have to be prepared for that and prepared for a lot of volatility and risk involved, but it can also be very rewarding. So anyway, the current overall economic picture is healthy, with low unemployment and stable prices currently in the oil and gas industry. Obviously, two important products involved are crude oil and natural gas, which are refined and used for various purposes. And while these are like the most important part of the industry, the infrastructure is also important. So this involves like how wells are drilled and oil and gas are extracted, as well as how they're refined. So infrastructure is also a really important part of it. A recent trend that the oil and gas industry has had to analyze and deal with is the increased societal interest in sustainable energy. So oil and gas are non-renewable energy sources, and society has an increased interest in renewable energy. So we're kind of combating that. So yeah. So let's take a look at the history of Shell to start with. So in 1883, Marcus Samuel expanded his London antique business into importing shells from the Far East, hence the name Shell. And this laid the foundation for an import-export business. Samuel's two sons later began to expand the company and became more focused on exporting oil in the 1800s, building on that import-export foundation. In 1907, Shell Transport and Trading Company merged with Royal Dutch and formed the Royal Dutch Shell Group, and led to great expansion of the company. It was a really pivotal time. It's also notable to point out that instability in the Middle East in the 60s and 70s led to a quadrupling of oil prices and led Shell to diversify, in particular to coal and nuclear power and other metals. So moving on to the 80s, in 1996, when the oil price collapsed. To adjust, Shell had to focus on developing their projects in a cheaper, more cost-effective manner. This led to improving drilling techniques. It was actually ended up being good for them, including the use of 3D seismic technology to search for new sources of oil. In 2005, the partnership between Royal Dutch Petroleum and Shell Transport and Trading was dissolved, and the company operated as Royal Dutch Shell. And then in more kind of recent history, in 2016, Shell created its new energy business to focus on exploring and developing commercial opportunities in renewable energy, such as wind and solar, to kind of play off the new trend in sustainable energy.
Great. So diving into Phillips 66's history, it actually originated as Phillips Petroleum in 1917, founded by brothers L.E. Phillips and Frank Phillips, and it was headquartered in Bartlesville, Oklahoma. And then in 2000, Chevron Corporation and Phillips Petroleum Company combined its petrochemical businesses to form what is today Phillips Chemical Company, LLC. Two years later, in 2002, Phillips merged with Conoco to form what is ConocoPhillips, and it was creating the sixth largest publicly traded company. And so this company will incorporate upstream, midstream, and downstream services. So that kind of explains the, how large and why it's so large in regards to publicly traded companies. Looking in 2012, the ConocoPhillips company spun off its midstream and downstream businesses, and they created what is today Phillips 66. And so that would be traded on the New York Stock Exchange as PSX. And we actually have as well the MLP, which would be traded as PSXP on the New York Stock Exchange. That leaves ConocoPhillips operating as just an upstream company. And so if we look at Phillips 66 today, it's a 14,000 plus employed company where it's headquartered in Houston, Texas, and it still has its office location in Bartlesville, Oklahoma as well. And in regards to assets, it has about 13 refineries spread out through the United States as well as Europe.
So now let's take a look at Shell's business model. As we stated before, Shell as a company originally started in London. So actually when we analyze these financial statements, we used a 20F instead of a 10K since it's originally a British company, but it also operates in the United States because it is an international energy company with expertise in the exploration, development, production, refining, and marketing of oil and natural gas, as well as manufacturing and marketing of chemicals. So as you can see, they do a lot of different things, and one of their competitive advantages, so one of their things that like sets them apart, is the integration of these businesses into one. So how they seek to create value is by exploring for crude oil and natural gas worldwide, both in conventional fields and from sources such as tight rock, shale, and coal formations. They also create value by cooling natural gas to produce liquefied natural gas, or LNG, that can be safely shipped to markets around the world and convert gas to liquids. They also turn oil and gas into a range of refined and petrochemical products, which are moved and marketed across the world for domestic, industrial, and transportation use. So a wide kind of variety of things there. Additionally, they invest in low-carbon energy solutions such as biofuels, hydrogen, wind, and solar power, and in other commercial opportunities that are linked to this new transition that's coming up.
Moving on to Phillips 66 business model. So the main focus of the business model is on their strategic.
Sorry guys, technical difficulties.
Their strategic priorities being growth, returns, distributions, and achieving all this through the foundation of operating excellence and having a high performance, capturing the opportunities in the midstream and chemicals areas. Returns are based on maximizing their earnings from existing assets such as refineries, pipelines, as well as investing in capital efficiently. The midstream incorporates the transportation of crude oil and refined products through terminals, pipelines, and trucks, as well as the storing of chemicals.
All right, moving into Phillips 66's segments.
This includes the process of refining the crude oil and other feedstocks into petroleum products such as gasoline, distillates, and aviation fuels. For the chemical segment, it consists of 50% joint venture interest with our joint venture CP Chem, and which manufactures and markets petrochemicals and plastics worldwide. And then we have the marketing and specialty segment, which deals with the marketing of refined petroleum products such as gasoline, distillates, and aviation fuels. And it also includes the manufacturing and marketing of specialty products such as base oils and lubricants.
Okay, moving into the financial statement analysis portion of the presentation. First, looking at the reformulation of our financial statements, which is one of the first steps we did after gathering all of the history and overview of the companies. And so doing the reformulation of these financial statements really allows us to make adjustments to get a more accurate forecast when you're using the residual operating income earnings model. And then from there, we can better compute more accurate ratios. And so when doing this reformulation, we are simply just separating the assets and liabilities into financing and operating. From there, we're able to separate them from current and non-current. And the reason we do this is because there is more value in the operating components of our financial statements versus the financing side. And so our results for Shell and Phillips 66 for common shareholder equity was 779 million, and for 56 it was 10,917,000.
So we took a look at a variety of ratios in doing our analysis. The first one is the operating profit margin, which is operating income over sales. And for Phillips 66, it was 0.12, and for Shell, it was comparable, but just a little bit higher at 0.17. This is a good number because it represents the true operating margin. So you have operating income, so basically interest items are taken out of it, and it's just truly how much you're making from operations. Next, we have the sales profit margin, which is operating income from sales divided by sales. And Phillips 66 was at 0.04 and Shell was at 0.11. And this is our income from sales only margin. So it just kind of is a little bit more specific there. Next, we have the net profit margin, which takes our comprehensive income and puts it over sales. Phillips 66, we have 0.14, and Shell is similar but a little bit lower at 0.12. This is just a measure of overall income. So the two preceding metrics are better because they're a little bit more specific, but it's also can be good to look at net profit margin. Next, we have capitalization ratio, which takes our net operating assets divided by our common shareholder equity. For Phillips 66, we have 2.08, and for Shell, we have 1.5. This is basically saying how much of our money earned is being capitalized. So how much of our how much are we putting into assets? Next, we have the financial leverage ratio, which is net financing obligations over common shareholder equity. For Phillips, we have 0.84, and for Shell at 0.53. This is basically saying what are our obligations compared to our common shareholder equity. Next, we have our operating profitability, or RNOA. This is our operating income divided by our net operating assets. And for Phillips 66, we have 0.55, and then for Shell, we have 0.05. And this is basically our return on net operating assets, and it's looking at, are we making money on our operating assets?
Moving on to the forecasting evaluation model of the comparables, our calculated per share price for Shell was $56.51. As for Phillips, it was $136.80. When we compared that to the market price, the Shell market price was $63.17 and the Phillips market price was $102.47. We would suggest that we sell Shell and buy Phillips 66. For the discontinued cash flow analysis, our calculated per share price for Shell was $251.20, and Phillips had a per share price of $253.67. When comparing it to the market value, we would suggest to sell both, as they are priced at a lower value than the market value.
All right, and then moving into our third valuation method, the residual earnings model. So we calculated the share price for Shell to be at $46.01, and for Phillips, we calculated at $228.07. And so again, if we're looking at comparing it to the market value, we would suggest to buy both companies. And finally, looking at our last method of the residual earnings operating model. And so this is where we're using the reformulated financial statements that we did. And so we came in with Shell at $369.04, and Phillips 66 had a price per share of $569.66. And again, looking at the market value currently, these are according to this, these are being way undervalued. And so we would suggest wanting to buy both of those. I know that says sell, but we'd want to buy both of those because these are being way undervalued and compared to the market value share price. And then just wrapping up with some recommendations and conclusions. Catherine, do you want to take it away?
Oh, no, you got it. Go for it.
Awesome. So yeah, just concluding up. So we found the residual operating income method to be the most accurate. And that's why we based our final recommendation, which would be to buy both of the companies because they're being so undervalued compared to the market price. And then again, this is just illustrating how undervalued both of them are. In general, though, and compared to both of the two companies, if you were only having to pick one or if you only had enough money to invest in one, we would recommend Phillips 66, being that we see them as a superior company, and that's in regards to the financial success. In conclusion, we think both companies seem to be performing well, and as I stated, we would recommend buying Phillips and over Shell for this. So that concludes our presentation. We look forward to hearing any questions you guys have for us. Thank you for watching.
Thank you.
Thank you.
I don't know how to stop. Nope.
Alt-R.
Alt, what?
R.